Good afternoon, good evening, everyone. I'm excited to speak with you all today, and I hope you find the presentation interesting, and please ask questions in the chat as we go along. If we can move to slide 2, please. So a lot of changes have taken place with the trust in the last couple of months. These changes were approved by shareholders in late July. And so just to level set within the presentation, I do want to discuss what those changes are, as well as what really has stayed the same with this portfolio and the value proposition. And so starting first, it's the same investment team. It's U.S. Income and Value at BlackRock. Your lead portfolio manager is Tony DeSpirito, 25 plus years of investing experience. He's supported by David Zhao and Lisa Yang as co-portfolio managers. And as you'll see when we get to the team slide, a deeply resourced bench of investment talent that supports fundamental research for the strategy. 2 is we continue to focus on the U.S. universe of stocks. We've previously really focused on large caps, but we are increasing our scope in our universe to look at multi-caps as well, and I'll touch on that in a moment. Now, we're also value investors. So same core discipline here. The price we pay for an investment is really important, and we're focused on high-quality dividend-paying companies. And so from a financial objective standpoint, that remains the same. We're targeting an attractive level of current income with long-term capital appreciation over the long term for 3 to 5 years or a full business cycle is how you can think about that. Now, in terms of enhancements, there are 6 listed here. I'll hit them fairly quickly. The first is we've evolved the mandate to have specific sustainability investment objectives alongside our financial objectives. 2, as I alluded to, we've transitioned to this multi-cap universe. The rationale here is as you focus more on ESG objectives, that inherently narrows the opportunity set of companies that we have to invest in. And so by increasing the cap exposure, we can buy more mid-cap companies. That gives us an ample supply of potential firms to invest in the portfolio. Thirdly is we've narrowed the scope of our holdings range. So 30 to 60 stocks should be your new baseline. We have 54 holdings in the portfolio as of the end of September. And so a bit more concentrated, more high conviction, but still diversified enough where we can source a variety of our tracking error or risk versus our benchmark through tilts into certain sectors or industries or themes in the portfolio. Fourth, we've committed to a structural level of portfolio gearing. Now, historically, as in most trust vehicles, we've had the ability to gear the portfolio over time. But you should view going forward 5% being our neutral level within a 0 to 10% range. We do sit at 0% today, and that is very much driven by the equity market recovery we've seen over the last 18 months. So fantastic returns for investors. We don't think now is the time to be dipping into the leverage within the portfolio. Last 2 changes, we've stopped the systematic use of covered calls in the portfolio. They were great for enhancing income. They've frankly detracted from absolute returns over time in a rising equity market, as you would expect a covered call strategy to do. And so the view here is we'll source less income from option premiums, but over the long term, we would expect to have greater capital appreciation through having a full equity exposed portfolio. And so being able to pay that quarterly income to our shareholders through a combination of the dividends we collect and the capital appreciation the trust can potentially achieve. Finally, we reduced the management fee by 5 basis points. Hopefully that's good to hear. And certainly from a competitiveness standpoint, we believe it positions the trust well relative to other offerings within the space. We can flip forward to page 6, please. So I want to focus in for a moment on the investment team that manages the North America or the Sustainable American Income Trust. I mentioned the lead PM is Tony DeSpirito. He is also CIO of U.S. Fundamental Equities at BlackRock. His role beyond the team is investments focused. And so He spends his day-to-day building portfolios, digging into research that our analysts build and create and deliver. And so inherently focused on alpha, and for this product, the sustainability outcomes that we seek to achieve. You can see in the yellow boxes here, 20 fundamental research analysts that are dedicated within the U.S. Income and Value team. These analysts generally will cover somewhere between 15 and 30 stocks on an ongoing basis. And then each year we task them with completing roughly 10 to 12 what we call research deep dives per year. That's analysis on new companies that we're vetting for any of our portfolios within the pillar. And so key takeaway, tremendously resourced. We narrow the analyst focus so that they can do deep research on companies to really understand the key drivers for their business. And we believe it's a source of alpha generation for us over the long term. You'll also see at the bottom in the purple colored boxes, the scale and scope of BlackRock is something that we can lean into here, especially as it relates to sustainability, not only from a data standpoint, but best practices, and also leveraging the size of BlackRock as we speak with company management teams, as we engage with them on ES&G related issues. Next slide, please. A lot of words on this page. I'll distill it down to a few bite-sized bullets for everyone. We believe that the most efficient way, or the best way, to deliver dual objectives of alpha generation and measurable ESG outcomes is through a combination of fundamental and ESG analysis and the identification of attractively priced, high-quality, dividend-paying companies. Many of these businesses compound their earnings over time, and we can be patient holders of as a result. 4 pillars to our investment approach. You can see them listed on the bottom left. From an ESG standpoint, certainly we want to focus in on companies and their environmental practices, how they're seeking to improve their carbon footprints, from a social standpoint and from a governance standpoint, the composition of their boards, how they treat their employees, how managements are compensated, how companies compare to their peers within their industry, as well as within the sector and the broader market. And so a lot of work goes into understanding how companies are, over the next 3 and 5 years, delivering better sustainable outcomes for our clients, but also for the broader population and the broader world. Second, value. This is the simplest one. The price we pay for an investment is incredibly important, and we believe it is an essential driver to long-term returns within this portfolio. Thirdly, quality. Now, we look at quality a number of different ways within the trust. We have screening capabilities where we can look at historical data and assess what is a company's historical returns on invested capital, historical profitability and margins, so on and so forth. But we ask our analysts to spend most of their time looking out the windshield of the car, so to speak, and focusing in on what is the durability of a company's revenue and earnings profile. Can they improve margins? Are they facing disruption risks? Are there ESG practices? If we're looking at improvers, how can they drive improvement across ES&G over time? Ultimately, our analysts, as I'll get into on the research side, they want to translate their takeaways from some of this analysis into our financial models and incorporate them into our price targets for companies. And then lastly, we focus in on dividend-paying stocks. We believe it tells shareholders and investors like ourselves a lot about management's conviction in their own business. We believe companies that are disciplined with how they allocate capital, how they can pay and grow dividends over time, ultimately can drive greater shareholder value over 3, 5, and 10 years. Lastly, you'll see in the middle of this page, we focus in on ESG leaders, improvers, and enablers. When we purchase companies in the portfolio, we try and bucket each stock into one of these 3 categories. And so what is an ESG leader? These are companies that are best in class, that are effectively managing ESG factors to benefit all stakeholders. 2 are ESG improvers, companies showing demonstrable progress in their ESG journey. And then thirdly, enablers. These are companies that are advancing transition towards or innovating towards sustainable solutions. They may have revenues aligned with UN Sustainable Development Goals. And we'll get into a few examples in a little bit to give you a bit more color there. Next slide, please. So this depicts our investment process. So I'll hit this fairly quickly. 3 main elements: idea generation, fundamental research, and portfolio construction. We have this circle in the middle of the page, trying to illustrate that this process is ongoing. There's no starting or stopping point. It continues every single day as we seek to identify the best investment opportunities for this portfolio. From an idea generation perspective, a couple of inputs here. We have our research screens. They focus on quality and value factors and essentially rank stocks in our universe according to elements that are important to us from a philosophy standpoint. And so it's unemotional. We can run the screen every day if we so choose, and it systematically seeks to identify high-quality dividend payers that trade at attractive prices, that have the ESG characteristics that we seek to own in the portfolio. Now, alongside that are the expertise and the creativity that our portfolio managers and research analysts bring to the table on an ongoing basis. And so we lean into their ideas, the conversations that they have with management teams, with sell-side research partners, with competitors and suppliers and so forth, and really want to hone in on, what opportunities are they identifying that perhaps the screen is missing? Because inherently, the screen is backward-looking, it's relying on historical data, and it might not be prospective of what will happen in the future. And so those inputs, along with our exclusionary ESG screens, which I'll touch on in a bit, really help to narrow and focus our research agenda. Part 2 is the fundamental research. And so that's the time that we ask our analysts to spend getting to know and understand businesses. And so as you would expect, we start with primary sources of information first. NKs, so annual reports, quarterly earnings. We ask our analysts to do their homework up front. We don't want them to be biased by other people at the firm who they may speak to, or biased by a nice pitch deck that a company management team might deliver, or that they can pull off of investor relations website. So do your homework up front. Identify the key drivers for the business over the next 3 to 5 years. What will drive earnings power? What will drive ESG improvement or sustainable ESG competitive advantages? And then do deep research on those 3 or 4 drivers and translate that into a financial model. And so at the end of the day, for each company, we have a base case, a bull case, or your upside case, and then your downside case as well. And these cases I would characterize as operating. So based upon a company's ability to meet a top end of our range for revenues or margins, you would get a price target of X. If they're at the middle of the range or the bottom of the range, the price targets would be a bit lower. And what we love to see is companies that have a nice risk-reward skew to them, limited downside risk, a lot of potential upside, and we want to be patient holders as we wait for the thesis to hopefully play out. You can see at the bottom under portfolio construction, as I mentioned before, 30 to 60 stocks, so fairly concentrated, fairly high conviction, wide guardrails around sector allocations and non-US exposure. Generally for non-US, the way we view it is as follows. A lot of the companies we invest in are global multinationals. So they're domiciled in the US, but they have revenues outside of our borders. And so inherently, when we're researching US companies, we need to do our homework on competitors that are based overseas as well. And so when there is a significant gap in potential upside by buying an equivalent non-US company, we're happy to do so in the portfolio to a maximum of 25% of NAV in non-US firms. We can flip forward to page 10, please. And so this slide tries to illustrate for you our ESG framework. And so we've talked a lot about alpha, as you can see in the top left-hand side, but we do focus on a couple of elements for this particular portfolio. So we seek to deliver a premium ESG score versus our benchmark. That's the Russell 1000 Value Index. This comparison is using MSCI scores. And so we want to have a premium overall score for ES&G, but also a premium score for ES&G individually within this portfolio relative to the benchmark. Two is, and you can see it in the bottom right, we're seeking a lower carbon intensity than our benchmark. So 20% is the target. Today, it's upwards of about 40% lower. We're measuring that in terms of carbon emissions intensity. And then thirdly, kind of rounding out on the bottom left-hand side of the page, as I alluded to a bit earlier, it's engaging with companies about their ESG practices. It's identifying companies that we believe are open to our feedback, that are putting plans in place to improve their environmental, social, or governance issues. I'll provide a couple of examples in a moment. And we want to track how they do that over time. And so it would be a red flag to us if companies, let's say that we purchase today, 18 months from now are failing to execute on some of the conversations we've had and some of the promises they've made as it relates to ESG or sustainability. Next slide, please. Okay, so again, a lot of words. I'll summarize this for you a little bit. We focused in on the top side here, the top end of the page in terms of premium ESG scores. In terms of exclusions, these are companies that we cannot invest in. So UN Global Compact violators, companies that are violating things like human rights or labor practices, making mistakes on the environmental side, to controversial weapons, civilian firearms, tobacco, fossil fuels, fairly typical here. Now, there are thresholds for this. So you won't see us buy, thermal coal companies or tar sands, but we do own a couple of energy firms. And as we get to the positioning part of the presentation, I think you'll understand why and what our view is here. But limited exposure to your traditional oil and gas or kind of carbon generating fossil fuels. Let's flip forward to the next page, please. Perfect. So I'll start with thematically some of our exposures in the portfolio, and then I'll allude to some specific examples, although I won't provide specific names in the portfolio for the purposes of this webinar. So you can see on the top hand and left side, our largest allocation in absolute terms is to the financial sector, also a healthy overweight for us versus our benchmark. And so this would fit into our cyclical value bucket in the portfolio. We're seeing a lot of opportunities across the sector, so this just isn't a bank theme or a play on insurance companies. We're seeing a lot of interesting firms in capital markets, in wealth management, that give us some nice growth characteristics, that give us exposure to companies in the sector that have strong ESG practices, et cetera, and so forth. Now, we do have several larger positions in U.S. banks. I would argue that is a hedge against a potential rise in interest rates. These are also companies that, since COVID hit, have been much more resilient than expected. When we look at loan loss provisions in 2020, banks were provisioning for potential losses as the economy was shut down and locked down. Central bank intervention in the U.S. in particular has really helped to ballast U.S. consumers. U.S. consumers are actually paying down debt last year as they spent more time at home. We're spending less on travel and certain services. And so as a result, the banks have been really, really well positioned as we've kind of entered the reopening phase post-COVID lockdowns. And so we've seen stronger earnings. We've seen lower than expected loan losses, a release of those loan loss reserves, and nicely on the capital return side, payment of dividends again, payment of growing dividends as regulators permit them to do so. And so really across the sector, some areas that we're really excited about. I do want to mention insurers just for a moment. And this gets us excited from an alpha standpoint, because we would argue that some investors are missing the ESG on, let's say, a property and casualty insurer. To kind of frame this for you without giving names, right? So if you're a property and casualty insurer, you are providing a service to companies, a service to households. If you live in the Gulf Coast in the US, you could be impacted by hurricanes. If you're in the West Coast of the US, increasingly wildfires may be a concern. And so in essence, property and casualty insurers are profiting from negative events related to nature. So some of these companies get penalized in terms of their ESG scores because they're generating money from these, calamity type of events. We actually believe that they should be praised for the nature of their business because they're transferring the risk of these negative events onto their own balance sheet. And so the insurance would be incredibly valuable if you have a house that was impacted by a storm or a wildfire. And so as long as you're an insurance company that's adequately pricing for that risk, your business can be profitable and you're doing a good service for society in our view. Secondly, I want to touch on healthcare. This is the second largest of our absolute exposures in the portfolio, and we would put this in our stability bucket. And so comparing and contrasting, we want that cyclical value exposure that can give us upside as the economy continues to reopen, but we want some positions in the portfolio that can also offer us greater stability if we go through periods of volatility in this, quite uncertain and unique environment. Within the healthcare sector, we like select pharmaceuticals as well as HMOs and med tech companies in the US. On the pharmaceutical side, we're looking for companies that have high R&D productivity, businesses that can develop and bring new drugs to market over time to help treat illnesses like cancer, so on and so forth. And so we've been finding some really interesting opportunities today, especially outside of the US within the pharmaceutical space. And we've focused in on, from an ESG standpoint, best actors, companies that are disseminating healthcare more broadly around the world. We've certainly seen that in the US with HMOs. So these are health insurance providers. They've been hugely important during COVID in terms of ensuring everyone in the United States is being given adequate care as it relates to not just COVID, but other illnesses that they may have. And so on the HMO side, it's in our stability bucket. We love the long-term secular growth of the businesses that's driven by aging demographics and the fact that we spend more on healthcare as we age, all else equal. But it's a bit of a reopening play as well, because these companies benefited last year from lockdowns. Fewer trips to the doctor is how I'd frame that for you. And then this year, they've been a bit more impacted by additional COVID costs for testing, so on and so forth. And so really cheap valuations among the HMOs today. We own a couple of them in the portfolio. And again, they're providing an essential service to society and so a public good in that regard. I'll touch on just a couple of more perhaps sector views and then quickly move to outlook, and then we can open up for Q&A. I mentioned energy a bit earlier. You can see on the right-hand side, 4.4% of the portfolio, so fairly small. That's about 4 companies that we own today. And so the way you can view our energy exposure in a portfolio that has sustainability objectives in a focus here is it's an acknowledgement that as much as we want renewable energy to drive all of our energy consumption today and tomorrow, we're not there yet. We still need traditional fossil fuels to help bridge that gap as we lean into more efficient and cleaner sources of energy generation. And so we focused in on companies, one out of Europe, for example, that is a European integrated firm. They've made tremendous investments in wind power. Roughly 25% of their power generation today comes from renewables. We focused in on a U.S. E&P company, best-in-class management team, best-in-class capital allocator in terms of the returns they generate for stakeholders. And so we believe businesses like this, selectively so, can have a really interesting and firm place in our portfolio, despite the fact that they play in traditional oil and gas. Lastly, I did want to touch on tech. It's a fairly big weight for us at 14%. It's an overweight for us versus the benchmark. The benchmark is about 10% today. We can tap into a lot of ESG leaders within the tech space. And so we've primarily focused in on software and IT services companies. Specifically on the IT services side, there's a top 10 holding that we have that manufactures switches and routers. And so connectivity and networking equipment for companies and businesses. We've certainly used that in the work from home environment over the last 18 months. They're also a leader among their peers in terms of ESG practices. So when we look at energy usage, when we look at water usage, far, far ahead of peers. And so that gets us really excited, both fundamentally, as well as what they're doing from an ESG leadership perspective. Similar theme for some of our software firms. Now, these are capital-light businesses. So as you would suspect, limited variable costs. Their fixed costs are more or less upfront. And so very, very efficient from a carbon standpoint, especially on the cloud side. Cloud computing is allowing us to reduce and centralize energy consumption. So away from data centers on site and to more efficient data centers that an individual company would run and manage. And so more efficient power generation through their technology. We think that's a great fit for this type of portfolio. Okay, very quickly on outlook. I wanted to frame first where we've been in the last 18 months, because I think that's important in understanding where we expect markets to go moving forward. And so if you will think back with me to the start of 2020, we were late cycle in the US, so a long business cycle, a long run for US stocks. And across our team's portfolios, we were getting a bit more conservative in terms of where we were finding opportunities. Quickly, COVID hit. That changed market dynamics completely. And so as a result, we went through a period where several different parts of the US market carried leadership in terms of performance. But first, your traditional defensive stocks did very well. We had the work from home winners, where their secular growth was accelerated by people working from home and the trends towards e-commerce, et cetera. And then on the value side, where we sit, at the end of, let's say, at the end of August in 2020, so a little over a year ago, we were seeing valuations in the market that were, on a relative basis, as cheap as we had seen since 2001 during the tech bubble and 2008 during the global financial crisis. So tremendous value opportunity, with the acknowledgement that this coiled spring, if you will, the catalyst for it to be released would be positive vaccine news. And that was a really difficult element to pin down in terms of timing. And so incrementally, we were leaning into value in our portfolios. We continue to do that today. So overweight to the value style factor. And then from a performance standpoint, value had a tremendously strong run from November of last year through about the end of April this year. Election clarity, positive vaccine news, both in terms of the drugs that have been rolled out in the vaccines, but the therapeutics and so on and so forth. Now, more recently, during the summer months in the US, we've seen growth stocks carry market leadership again. That's been driven by a couple of elements. One would be fears around the Delta variant and how that could impact economic growth in the coming quarters. Two is a lot of the supply chain disruptions that I'm sure you all have read about, heard about on the news and so forth. And so the impact of those disruptions, at least in the immediate, is a cap on supply from certain companies. If you think about auto OEMs, just restrictions in terms of how much they can output, how many cars they can produce. because they don't have enough semiconductor chips to put in the vehicles, just by way of example. And so where we sit today, we're going through the early stages of 3Q earnings. We continue to focus in on whether companies can price for higher costs. They have been able to do so far, and splendidly well, I would note. Earnings growth has been exceptionally strong over the last 3 or 4 quarters. Now they're off of low levels, but strong nonetheless. And revenue growth has been even stronger. That's a key point, because revenues are growing faster than earnings. That's telling us that companies are able to pass through higher input costs, whether those costs are due to paying labor more to do their jobs, or paying for, raw materials is becoming more expensive, greater friction within the supply chain. All of those higher input costs, companies, broadly speaking, have been able to pass through to end customers and consumers. So a lot of pricing power on the corporate side. And so we're watching this earnings season to see if companies can continue to deliver in this regard. We think certainly that growth will slow from here, from elevated levels, that you could see some cracks, some areas of margin pressure for certain companies. But by and large, that firms will continue to be able to price aggressively for the inflationary pressures that they're experiencing. Now, the reason for that, I mentioned it, it's the strength of the U.S. consumer. And this is unique relative to what we typically see in a post-recession environment. So exiting a typical business cycle recession, we would have expected unemployment rates to be very high. Consumers generally have dipped into their savings, and so they don't have a lot of excess cash to spend. Now, the uniqueness of COVID has created a different setup. Consumers were spending more time at home last year, so lockdown scenarios. In the U.S. in particular, direct checks from the government to lower and middle income households. And so household balance sheets exiting this COVID recession are exceptionally strong. And we just don't typically see this type of setup in the immediate months and periods after a recession. And so that consumer strength, we've seen it in terms of demand more recently for flights and for travel, for a return to normal in terms of how we live our lives. And certainly from a goods standpoint, big ticket purchases, autos, home renovations, and so on. And so overall, we continue to be constructive on U.S. stocks. Policy continues to be stimulative on the monetary and fiscal side, and we believe, fairly easy. Yes, there's talk of the Fed tapering in the U.S. and pulling back on its bond buying program. Even under that scenario, as they begin to taper, it's still overall stimulative for the economy, and we think something that will be, phased in gradually over time. Certainly some questions around the ultimate timing for the Fed. It's a bit of a tricky scenario for them, given the uniqueness of the situation and the reliability of economic data. But nonetheless, policy still, I think, firmly pointing in the upward direction for stocks. Now, in terms of risks, I would point out to you that valuations are a bit elevated. So high versus history in an absolute sense, in a relative sense as well. However, when we look at valuations for stocks versus other risk assets like bonds, we would argue that stocks remain attractively priced for the risk versus reward that they offer. And so the key takeaway should be your return expectations within stocks should be a bit more muted, given how quickly stocks have accelerated higher in the last 18 months. But we would still expect from a 3 to 5 year standpoint, mid-single-digit investment returns per annum seem reasonable to us, and we remain constructive overall. I'll pause here and see if we have any questions, but that ends my prepared remarks, Mike.
Thanks very much, Nathan. And Scott, are you going to join us as well at this stage in case there's anything you want to answer? And feel free to turn on your mic and video camera. We've already got a few questions coming in, but just a reminder, if you want to ask a question, if it's not already up on your screen, please do type away and we'll get through as many as we can. So Nathan, the one that seems to have filtered to the top so far is, as this trust has a strong focus on income, what is the future for income, as you have stated that you are to abandon the policy of a progressive dividend?
Sure. So, and Neil hits on this as well, I think, in his question. The portfolio today has a 1.9% dividend yield, so certainly not a high dividend yield, but we would argue it's competitive in the U.S. relative to some of the alternatives. And so I would expect a gross dividend yield of our portfolio holdings, let's call it 2 to 2.5% over time. We certainly will give up some of that income given the discontinuation of the covered call strategy and the premiums that we could collect there. But from an expectation standpoint going forward, call it 2 to 2.5% gross. That number can move around a little bit based upon market price movement and the impact on the yield figures.
Okay. And that's pretty, I'm not that familiar with collectors in the US that are driven for income. Is that pretty typical? It's that level? Are you more familiar with the UK-based income stock, income trust and so on, which tend to be a slightly higher yield, I guess, than you're talking about? But that, I guess that's just the nature of the market you're dealing in, is it?
So the trust yield we can source both from dividends. So that 2 to 2.5% is from the underlying dividends in the portfolio, but then that higher yield, closer to 4%, reflects the return of capital that we can also utilize within this vehicle structure.
Okay, thank you. Question here on renewable energy, and a question as to whether you're using hydrogen and fuel cells. Sorry, you're looking at hydrogen and fuel cells as part of your investment portfolio.
Good question. I think where we struggle a little bit here is a lot of these companies are high growth, or they're certainly priced as high growth. And so from a value standpoint, we're looking for opportunities, but not finding a lot today. I mentioned on the OEM side, the company that we own has a tremendous investment in electric vehicles. And so we're trying to find ways to incorporate that into the portfolio. But I would expect it to be a bit smaller than a core growth style offering within the trust space.
Just moving on, one question here. What initiated, oh, sorry, I've just clicked on the wrong one. Bear with me. How many legacy portfolio companies pre the change of the objectives for the trust are not now meeting your new criteria and have been or will be sold?
Yep, so the portfolio changes have been fully initiated. They were executed within basically 1 or 2 trading days in early August. We do have some legacy positions that we continue to own. I'm happy to run the full figures after the call, but I believe it's about 30 to 40% of NAV was retained through this transition process. I see a couple of questions here too about, peer group performance over the last 5 years. So I wanted to address that one as well. The biggest driver of underperformance for us versus peers is that we haven't used leverage in this portfolio. We do tend to be fairly conservative. That's Tony and team's prerogative in terms of buying high quality dividend paying companies, being resilient during market drawdowns and participating in bull markets. And so the covered calls, yes, they boost income, but they've been a constant kind of drag on performance amid an equity market that's essentially went one direction, not just over the last 5 years, but the last 10. And so I'd say a combination of the conservativeness that we run the portfolio stylistically, the use of options, and not utilizing that leverage capability more have been the 3 contributing factors.
Okay, so so based on that, I guess we'd expect to see you coming more in line with the peer group, as it were. Okay. Assuming Biden gets his way in Congress, I know there's a big bill going through at the moment, but let's assume that most of it comes through. How do you expect those key objectives to affect your investee companies?
A loaded question. So I'll take it, or maybe split it into two parts. First, on the tax side, we'll see if we get tax reform. Our base case is still Biden rolling back about half of the Trump tax cuts. We've stress tested our portfolio a little bit here with the help of BlackRock's risk and quantitative analysis team. We're roughly in line with the benchmark in terms of expected impacts under that scenario. And the details will be incredibly important. How revenue generated in subsidiaries of U.S. companies that are overseas, those types of things could potentially impact healthcare and tech companies more than some other segments. Certainly from just a raw tax rate standpoint, some smaller cap companies face greater impact given their U.S. revenues. We'd expect financials. Some of the consumer names that we hold, it's almost all U.S. revenue exposure. They could be a bit more hit there. But versus benchmark, roughly a push. More broadly to this potential spending package, we're hopeful a deal can be passed, one that is more infrastructure centric, but certainly also weighing the pros and cons of additional debt accumulation to the tune of $1 trillion+. And so I think in the near term, no U.S. debt concerns. In the medium to longer term, there are certainly limits to that. And so we want to see, fiscal responsibility as well. So we're not modeling a lot of this into our stocks yet, but on the margins, trying to get better understanding and speaking to policy experts and speaking to companies in terms of what their views are for potential scenarios that they face.
Okay, thank you. The bit of a classic one here, really. There is a lot of evidence that passive investing beats active management. How would you counter this view, which is gaining media coverage by the day? This argument has momentum. Over to you, Nathan. Justify your job.
Look, the bar is certainly higher, and I think that's a good thing for shareholders. And so we see that in the U.S. We see that with our products domiciled in EMEA and sold in the APAC region. You need to have a clear value proposition, and alpha investors need to deliver upon that. Specific to ESG, I think the active angle is important. And so you can buy companies that in an ETF or highly on ESG, but we would argue there's a lot of inefficiencies in terms of how ESG are viewed today by the rating agencies. So if you just look at how MSCI scores compare to Sustainalytics, how they compare to our internal data set, which we call SIMBA, there's a lot of disagreement. Disagreement is good for active investors because that means there's alpha potential. And we believe we have the tools and the capabilities and the depth of research at BlackRock to be a bit ahead of the market in some of these areas. So predicting companies that can improve their ESG scores over time before they improve those scores, we think can be a boost to the multiple, to a boost to performance. But point well taken. ETF products are a growing part of the pie. And we think you need to, in a diversified portfolio, use both ETFs and active to construct efficient alpha.
Okay, thank you. I think you've touched on a little bit of this already, but with the present volatility in things like commodities, shortage of labor, major bottlenecks in the global supply chain, how do you see it affecting the portfolio at the moment? Is there anything more you want to add to what you've already mentioned earlier on?
Yeah, maybe just a couple of industry examples. We're seeing on the retail side in the U.S., supply chain issues impacting, as I mentioned, input costs. And so retailers, when we speak with them, have really been highlighting that and starting to bake that into their near-term numbers for the next 1 or 2 quarters. We expect the supply chain issues to be worked out over time. So they won't be solved tomorrow. If you're doing holiday shopping, I'd suggest starting early, especially if you're in the U.S. We're hearing from companies that, before a major holiday, ideally they want to have products, 2 months in advance. They want to be able to promote and advertise. They're getting the products with a much shorter lead time. And so that impacts their ability to do so. But as we kind of look out 12 to 18 months, we expect the supply chain issues to gradually resolve. We expect companies to slowly begin to rebuild inventories. And so that plays into this normalization theme that I've been talking about. I'll give you one other example on the OEM side. So auto producers, a lot of fixed costs here. And so when you're manufacturing vehicles, but you can only manufacture, let's say 75% of it before you kind of got to stop within the supply chain. From an earnings standpoint, that creates some variability quarter over quarter. And so we've seen some higher costs and some lower revenues as a result, and they'll kind of flip as we look forward into next year. But a lot of puts and takes and a lot of interesting challenges for companies to navigate.
Sure. Okay. Thank you. One final question here. What can you tell us about the typical retail investors who presently invest in the trust? Have you got any sort of characterization you could give us on that?
Sure. So this trust, it dates back to October of 2012. And the way we've marketed this trust over time is to be large cap, high quality, to be a steady performer. You shouldn't expect us to be the top performer in the peer group in a sharply rising market, but competitive performance over time in bull markets and resiliency during periods, or I should say potential resiliency during periods of declining stock prices. And so historically, we have achieved that. And we've achieved that within a bull market. So admittedly, the ramp up has been more than the declines, which that's okay. That's great for our clients to be in a 10+ year bull market.
That was the last question. So I think at this stage we can draw that to a close unless there's any more coming in. One last chance. No. Well, we're pretty much on time, so that's perfect. So Charlie, Nathan, Scott, if you're still there, just thank you very much for today's presentation. I found it very useful and insightful. Been helpful for me just to get to know a lot more about this particular investment trust. So I wish you well with your new strategy and the changes that you're making to the portfolio. I shall definitely keep an eye on things and how they're going in the next year or so. So have a good evening or good afternoon, wherever you are.
Bye-bye.
All right. Bye for now.